The Lifetime ISA is a savings account that was introduced to help first-time buyers save for a deposit and to help those saving for retirement. But now the government has announced it's going to replace the product. So what does it mean for first-time buyers and what does it mean for those saving for retirement? Welcome to this podcast from Which. Hello, it's James Rowe in the Which studio, and alongside me today we've got our mortgages and property expert Sam Wilson. Sam, hello.
Hi James, how you doing?
Very good, thanks. Nice to have you back. And joining us for the very first time, I believe, on the Which Money podcast from AJ Bell, it's Rachel Vahey, Head of Public Policy. Rachel, hello.
Hello, James.
Nice to have you on the podcast. Sam, do you want to just give us a bit of a timeline of the Lifetime ISA so far? We know it's going to change, but how did we get here? Where did it first come about?
Yeah, of course. So it was first introduced in April 2017, and the big news with the Lifetime ISA was that you got a bonus of 25%, a pretty generous bonus for if you were going on to buy your first home or withdraw your money towards retirement. Now, that was limited at a bonus of £1,000 per year, but still, pretty generous. There were some restrictions, so you needed to be between the age of 18 and 39 to open the account. And if you're using the Lifetime ISA to buy your first home, it had to be under £450,000.
And obviously the big sort of incentive, as you say, is that 25% bonus that you get paid from the government. There is also the saving for retirement element, which we will get onto. I guess the big thing about the Lifetime ISA to begin with when it was first introduced is it sort of upped that upper limit for the houses that you could buy to 450k. Beforehand, it was the Help to Buy ISA, wasn't it? Which I think the limit was about 250k. So it did really sort of open the property market to a lot of people who I imagine sort of felt a bit alienated by it and a bit left out, I guess, didn't it?
Yeah, definitely. And, currently we see UK house prices, the average UK house price is £271,000. The average we're using here is Land Registry data. We use this average from the Land Registry because it is the prices that people actually pay. So with other indices, you may find the listed price, but with the Land Registry, it's the price that people actually pay. So the UK average is £271,000, so well below that £450,000 limit, meaning that, the typical first-time buyer is going to be able to use a Lifetime ISA when they're purchasing their first home. But average prices in different parts of the UK, when we either look at the regional level or at the local authority level, are much higher. So London, for example, the average house price there is £553,000, well above that £450,000 cap. And then if we look at kind of either smaller cities or local authorities, so we've got Cambridge, the average house price there is £494,000. In Oxford, the average house price is £508,000. And then Buckinghamshire, we've got the average house price there is £478,000. So what all of this data and all these numbers that I've just told you kind of tell us is that, yes, for the typical first-time buyer, that £450,000 limit is really not a problem. But there are people where that limit is simply not high enough. And people who are living in London or other expensive areas will not be able to benefit from a Lifetime ISA when buying their first home.
Yeah, thanks for all those numbers, because I think it really helps paint that picture, doesn't it, about how useful the Lifetime ISA has been and can be for some people, but equally how it almost blocks a lot of people out in certain areas. Rachel, do we know how successful the Lifetime ISA has been in terms of how many people have been using it, how many people have opened accounts? Has it been a success story?
It has been fairly successful. I think we've got to acknowledge it's still really quite early days. As Sam was saying, it was only introduced in 2017. So we still don't have a full picture of how successful it could be. The latest data we have from the government goes back to 2023-24. The government's not keen on updating its data very quickly. So we're on a bit of a time lag. But there was almost 1 million Lifetime ISA accounts paid into in 23-24. And that was £2.35 billion was paid in. And that both of those figures are about 25% increase on the previous year's statistics. So I think that's showing that it's a steady progress, that more and more people are using it. When it comes to the other end and how many people are taking the money out to buy a house, then that's really quite interesting. It's about 87,000, I think it was just over 87,000 in 2023-24 who used their lifetime ISA money to pay for a deposit. And that was a 50% increase on the previous year. So definitely, I think what we're seeing is that 6, 7 years into the product, that more and more people are saving money, and it's actually now starting to be used for one of the purposes that the government originally outlined, to help people put down a deposit for a house.
And not only are people using it more, but it also costs the government or us, the taxpayer, money to sort of pay out that bonus as well. I was reading a Treasury Committee report from last summer earlier on. Rock and roll, I know. And it said that it'll cost the taxpayer £3 billion to pay out those bonuses over the next 5 years. Is it worth it for the government to be paying out all that money, do you think, Rachel?
Well, I think the government's one of its central policy objectives is to build more homes. We know that's a central figure at the moment, and that's certainly an intention of what they want to do. So if they are going to build this 1.5 million new homes over this parliament, then they're going to need to find a way to help people save for it and to buy these houses. Now, having a bigger supply is obviously, I think what the government hopes is going to bring house prices down, or at least put some sort of cap around house price inflation. But people still need the money to be able to buy the house, and they still need a way to save. So the lifetime ISA, I think it's actually quite a neat little product if you are using it for that purpose. And certainly the bonus is very welcome. It works in a better way than its predecessor, the Help to Buy ISA, did. And it makes it easier for people to use it to buy that dream home.
I guess the government can almost recoup some of the money as well, because of a bit of a quirk to do with the lifetime ISA is because if you withdraw the money not to buy your first house or when you're saving for retirement, that there is a penalty to pay as well. Just some more stats. I know we do like stats on the podcast, so I'll give you some more. From that same report I mentioned earlier, it was almost double the amount of people who made an unauthorised withdrawal in the 23-24 financial year. About 100,000 people did that, compared to around 57,000 who used their LISA to buy a home. And the report concluded that because of that, the LISA isn't exactly fit for purpose in that way. Is that kind of one of the pillars as to why the government is looking to replace the LISA with a different product?
It's certainly one of its flaws. I mean, the lifetime ISA, as I was saying, I think it is a neat product, but it does have some drawbacks. And the withdrawal penalty is certainly one of them. So what happens is, as you say, you get a 25% charge if you take it out for your money out and you're not over the age of 60 and you're not buying a house. And originally that sounded quite equitable. You got a 25% bonus on the way in, 25% charge on the way out. That sounds quite even. But when you do the maths, you realise that what happens is that charge takes away the government bonus plus any investment growth or interest growth on that, plus it takes away 6.25% of your own savings. Now, I don't think there's many places now within financial services where you get an exit penalty. So a 6.25%, I think, is actually quite a good, bite out of your own money. And the government did this to try and put people off just taking the money out willy-nilly and, just because they needed it. But I think when you look at this, if people's plans don't stay the same, people need access to money because life happens. You could set off and think, I am going to buy a house in 5 years' time. I will put my money into a lifetime ISA. You start saving, but life gets in the way. That's just what happens. And therefore, you might need access to your money. And I think it's really unfair that people who are taking that money out are then penalised. And especially when we consider that this is directly aimed at younger people. And they're the ones whose lives are so much more fluctuating and changing and can change so quickly that I just think it's a really unfair penalty. I would have probably preferred the government just to sit back and tackle these flaws within the lifetime ISA. The withdrawal charge being one of them, but also the £450,000 house purchase cap, because as Sam was saying, it works for some people in the UK, but it just doesn't work for everyone.
Yeah, going back to those numbers you mentioned earlier on about the £450,000 limit. So if you were to buy a house with a lifetime ISA, you can't buy a house worth more than 450k and get that government bonus. That is just another, again, I used the word pillar, didn't I, for the reasons why they want to change the product. That is another one as well, isn't it, that 450k limit, because it's simply not fit for purpose for a lot of people, is it?
Yeah, definitely. You look at the amount of people that are looking to, the places that I mentioned, London, Cambridge, Oxford. These are places where people are working, and it's completely reasonable that people want to live in the place where they work. So it makes sense that as house prices have grown over since 2017, that we continue to look at the cap and think whether it's suitable and whether it actually helps people, especially that target group of first-time buyers that we want to get into home ownership.
Yeah, we're 9 years on, aren't we, since the lifetime ISA was introduced, and that limit,
Scary.
It is scary to think 2017 is 9 years ago, and that upper limit hasn't increased with anything, not with inflation or anything. So it's almost as if that cap has come down in real terms when you look at it like that, hasn't it?
Yeah, definitely. We've definitely seen that what you could get for £450,000 in 2017 is very different from what you can get for £450,000 in 2026. Even though, house prices have come down a little bit from the COVID peak that we saw, especially when people really valued space and wanted to get out of these big cities like London. But still, the figures, £553,000 for the average price for a home in London it's a lot of money.
It is. It is a lot of money. Yeah, there's no beating around the bush there, is there? Rachel, do you think that needs to be one of the biggest considerations for the government then when it goes through this process of deciding what the new savings product looks like? This 450k limit, that needs to be a big consideration, doesn't it?
I think so, yes, it certainly does. And when they're designing it, they need to, there's lots of elements that we still don't have any idea really where their mind is or what they're going to do. But they could be looking at things like the bonus and how much money is paid. They could be looking at things like age restrictions and whether they widen it out or not. And again, as you said, that 450,000 feels like a barrier to me. So I think, again, will they increase it? But how much will they increase it by? It's still, as you were just saying, 550,000 is a lot of money. But those are the house prices that people in the London and the southeast are contending with. So, yeah, they should maybe think about how to change that. The government's going to consult on these on the new product some point over the next few months. It's going to start its consultation process on that. So once that happens, we should be able to get a much better idea of what this new product is going to be like and exactly how it's going to work.
And at this point, we don't have much of a steer at all, do we, what the new product's going to look like?
We don't really. We do have a couple of clues. One of them is that the government bonus is not going to be paid up front. So it's only going to be paid when you actually use it to buy a house. So that takes out all those problems with the withdrawal charge that the government's having at the moment. So it just avoids that altogether. The other thing we know is that it's only going to be aimed at house purchase. This new ISA it's a help to buy ISA, really. It's only going to be aimed at people who want to use it to buy a house. So it's not aimed at helping people save in the longer term or for other medium or longer term objectives. It's just for house purchase.
I imagine there'll be a lot of people who will be quite disappointed to find out that the bonus won't sort of be paid up front, because then you don't get the added bonus of having that in your account and that building up interest and whatever. So I guess there's almost a bit of a penalty there. Disappointing to a lot of people, I imagine. We'll come on to saving for retirement in a moment, Rachel. But Sam, I guess what we're talking about here just sort of feeds into the wider conversation, doesn't it, about making house buying easier for first-time buyers. Does the industry need to sort of do its bit as well to support those looking to buy a house for the very first time?
Yes, of course. So what we're talking about here is a government initiative to try and make it easier for people to purchase their first home. What we're seeing is that a small group of lenders are also bringing out some really innovative products that are really aimed at the group of first-time buyers that are really struggling to save enough for that deposit. So Skipton Building Society are a lender that brought out the track record mortgage. So with the track record mortgage, you can have a 5% deposit, but you can also have no deposit at all. And how they've kind of been able to do that is they use your rent payments to be able to work out what you can afford. So this is a really great product for people in London, and when their rent is very high, they can't necessarily save for a deposit, but they've got plenty of evidence that they're able to pay lots and lots of money each month.
And that's often a big complaint, isn't it, from people who are renting and they are paying out hundreds, if not thousands of pounds a month to be able to rent. And a lot of mortgage providers don't take that into consideration, and yet it's proof on paper that you can afford those payments every month.
Yeah, exactly. It must be so painful when you know that you've paid way more than maybe the mortgage, the monthly cost of the mortgage, and someone's turning around and saying you can't quite afford that. So Skipton Building Society, this is a great example of one of those innovative products. But there are other ones. So last week, Santander brought out the My First Mortgage. So this is a product where you only need a 2% deposit. The little caveat is that minimum deposit that you need to qualify for this product is £10,000. So it might just be 2%, but you still need 10k deposit. And then the last one that I wanted to spotlight was Yorkshire Building Society have the £5,000 deposit mortgage. Quite simply, it's £5,000 that you need for a deposit. But the nice thing about this mortgage is you can have it where that £5,000 is only 1% deposit. So it just opens you up to being able to borrow more money, and you don't need to save for as big a deposit as you would for if you're going for 90% or 95%. Now, one of the things to bear in mind with these innovative products is they are great in that you need a smaller deposit, either the actual money or in LTV terms. And by LTV, I mean loan to value. But because these products are more risky, because of the size of your loan is going to be proportionally much bigger, the rates are going to be higher. So we see the rates for these products range from kind of 5% to 5.5%. So people, I look at mortgage rates a lot. I imagine that other people don't look at mortgage rates a lot. So just for a little bit of comparison here, the typical best rate for a 90% LTV mortgage for a first-time buyer, so that's a 10% deposit, is 4.1%, and for a 5% deposit is 4.53%. So as you can see, the rates are much lower if you have those bigger deposits, and it's just something to think about because it does mean that your monthly repayments might be slightly larger. But the main point from this is that there are innovative products, there are things that lenders are doing to try and help people who can't necessarily save for these big deposits that they need in expensive areas. And this is where, if you are a first-time buyer, it can be really helpful to get some advice from a mortgage broker, and they can just kind of spell out to you the different products that are out there and whether those products suit your individual circumstance.
So things are moving in the right direction. I think that's what we can definitely take away from that.
Yeah, definitely.
Let's move on from first-time buyers, and we'll touch on those saving for retirement. It's not just Treasury Committee reports that I read on afternoons like this, Rachel. I also read things that you write on the AJ Bell website, Rachel, because I've got a quote here. I'm going to put it to you, just so you can flesh this out a bit more for us, because you wrote on the AJ Bell website last week or a couple of weeks ago, by only focusing on helping those buying a house, the government is leaving fewer options for those who might use a lifetime ISA to save for retirement. Tell us more.
Well, it is a useful product if you are saving for retirement. So there are a group of people who might want to use a lifetime ISA at the moment. First of all, self-employed. When you are self-employed, you're not automatically enrolled into any sort of pension scheme. So if you want to save for your money for retirement and you want to put away that money, then if you do that through a lifetime ISA, if you're a basic rate taxpayer, then you get as good a deal on tax advantages as a pension, if not better. You get the 25% bonus up front, it gets added in, and you can take out your money anytime you want. And I would imagine if you are self-employed, a basic rate taxpayer, and fairly young, then getting hold of your money when you absolutely need it, even if you have to pay a charge for it, is probably still worth having that flexibility. So there are other people who might want to use a lifetime ISA, other basic rate taxpayers, people who have maxed out their pension contributions and their employers' pension contributions under the pension and want a little bit more flexibility, they may consider it as well. So it is a good product for these people who want to save for retirement, because you do have the flexibility of being able to get hold of your money. It's not tightly tied in as it is under a pension, although you've always got to be aware that there would be a charge if you accessed it before the age of 60.
Rachel, remind us, has the government announced when lifetime ISAs are going to close in terms of opening one up?
No. So all of this again is up for consultation. It's going to be an exciting consultation paper to add to your reading pile, James. Yes, because I can tell you're in the zone with this one. So it's going to come out in the next few months, as I said. What the government has said, though, is that it's not a case of this new house purchase ISA comes out, this new product, and then they're going to scrap the lifetime ISA completely. It's not going to work like that. So anyone who has got a lifetime ISA, when the new product comes in, will be able to keep it, will be able to carry on paying into it, and then carry on using it for retirement or for a house purchase. So that's the good news. And especially when you think about someone using it for retirement, if there are 22 or 21 at the moment, then it's the lifetime ISA is obviously going to have to run for, a good few years yet until these people are going to reach 60. So we expect it just to carry on. In a way, that's good news, because it means that those people who've got lifetime ISAs don't need to start thinking about, do I need to transfer it, or how does it work, or what should I be doing? But on the other hand, it's bad news, because that doesn't look like the government's going to make the changes that we're calling for under lifetime ISA. So it will still have the same flaws under the withdrawal charge and with the £450,000 house purchase cap as well. So it's a little bit of a mixed bag, and we really need to see the detail from the government to figure out what all that means for people who have got a lifetime ISA at the moment, or those who may think, well, actually, I might hedge my bets a bit and take out a lifetime ISA before it disappears completely and I can't buy a new one when this new ISA product comes in, say, April 2028.
I think that's the thing, isn't it? We're just so impatient to find out what is going to happen next. And it's interesting that you say that as well. For a lot of people, if they don't currently have a lifetime ISA, there's no real harm in opening one, sticking a quid in it or a tenner in it, just so you've got one, just in case. You've then got that mechanism available to you, should you actually need it.
Yeah, I would probably agree with you. I think there's a couple of bits. First of all, that we don't know. You're always going to have that withdrawal charge if you do take out your money. So you've always got to be aware of that. But the second thing is, at this present moment in time, today, February 2026, I don't think there's an immediate rush to do that. I think it's a case of just maybe waiting and seeing what the detail is, because hopefully the government's going to put in place some nice transitional arrangements as well, that you can maybe move from one product to the other. And there is so many unanswered questions, as you say. We're all really impatient to make this decision, make this call about whether it's going to be better or worse for first-time buyers. But we just need to be a little bit patient, sit back and wait for the detail to come to us. And then we can figure out what the big decisions are to be made and when people have to make them by.
Sam, just one last one for you before we wrap up. I appreciate we've sort of spoken there about saving for retirement, but just to quickly move back to saving for a deposit for a first-time buyer, just any other final considerations you think they should have? You know, they know that the 450k limit is going to be there for the foreseeable, but just generally across the board, any other advice for first-time buyers?
I think going back to that point about speaking to either a broker or doing your research, maybe on the Which website, about all the different options that you might have as a first-time buyer, because there's lots to think about. It can be very daunting, especially when we throw around the big numbers. But there are solutions out there that will work for some people. They won't work for everyone, but it's just important for you to be aware of all of the different options, just in case one of them actually works for you and it opens your eyes and think, oh, actually, this might be an option for us now.
And Rachel, last one from you. Any other final considerations, whether it be for first-time buyers or for those looking to save for retirement? A very big question that I'd like answered in about 30 seconds, so apologies.
I think it's just a case of just at the moment, maybe just keep with your current plans and start saving, because as soon as you can start saving for whether it's retirement or whether it's your deposit for your house, the earlier you start, the easier it's going to be over the long run. So don't let this put you off. Just make that jump and just get into good habits and start saving. And then once we get all the detail of how it's all going to pan out, you can then make that decision, but with full knowledge behind you.
And also be patient, right?
Be patient. Yeah, it will all come to us, I'm sure.
Lovely stuff. Rachel, thanks for joining us today.
Thank you. It was a pleasure.
And Sam, thank you.
Thank you very much.